going to be talking very specifically on real estate today and how we can take these losses to offset our active income. Okay, so as you remember the last time we spoke, real estate is governed by Section 469, and it's very strict on when we can and cannot take those losses against our ordinary income. For this discussion, we're going to break our activity into three buckets. Okay, our first bucket is fully passive. If our real estate lands in fully passive, meaning we are not a real estate professional, we do not materially participate, it's fully passive, we do not get any losses against our ordinary income. Now, there is a special $25,000 allowance, which means is if our adjusted gross income for the year is less than or equal to either $75,000 if we're single or $150,000 if we're married, then we get $25,000 of our passive loss against our income, against our ordinary income. This is only if we're below those income thresholds though. So there is this possibility where even if we just actively participate, meaning that we own at least 10% of the property and we have some sort of management decisions with that property, then we're actively participating in the property and we're able to take that $25,000 against our ordinary income. But we're limited to that $25,000. So if we have $100,000 of losses from a property, that means this $25,000, we can only take $25,000. The remaining $75,000 will be rolled forward into the following years. And so that leads us to our third bucket. Now this is where we get a full deduction. Okay, a full deduction, meaning that this is not passive anymore. It's an active loss to us, and we get to take it against all of our other income. Now, if you'll remember from our previous video, we always have to materially participate. Okay, that is something that we always must do. If we want to take the losses, you have to materially participate. Now, there are 7 different rules. The main 3 that we look at are in the previous video. If you don't remember what I'm talking about, jump to the previous video, write those suckers down. Those are the 3 ones that we focus on majority of the time. We only have to hit one of those. We don't have to hit all 3 of them, just one. So we have to materially participate. And then on top of that, we have to do one of the following. Okay, we either have to be a real estate pro, which is what we talked about on our last video, right? We have to hit the 750 hours, and it needs to make up more than 50% of our income generating activities. So 750 plus hours in a real estate specific trade or business. And then we also has to be more than 50% of our income generating activities. So what this means is if you have a full-time W-2 job, you work 2,000 hours a year in that job, you would have to prove to the IRS that you spend at least 2,001 hours on your real estate. Very unlikely. If you have a W-2 job and you work full-time and you're going to try to say that you're a real estate professional, I actually don't even usually let any of our clients do that because you're 9 times out of 10, you're going to lose unless you are very, very detailed in your documentation and you can prove that you have an extra 2,000 hours on top of your regular full-time job. So it's very difficult to prove that. Okay. So that leads us to our second option. Okay. Or our second option. Now, this is something we haven't talked about yet. We have an average rental period per renter, average rental period of 7 days or less. Now, what this means is these are your Airbnbs, your VRBOs, and your vacation rentals. So if you have a vacation rental property that has an average rental period of 7 days or less, this means that you do not have to be a real estate professional in order to take the losses. All you have to do is materially participate in that property, meaning you self-manage it, which is relatively easy. Not easy, but relatively easy. But as long as you self-manage those properties, you are then able to take the full losses from those properties against your ordinary income, which is huge. This is called the short-term rental loophole. That's huge. That is very big. It allows us to get around those strict real estate professional rules in order to allow us to take the losses. Okay, so we're going to talk about some strategies in the future around short-term rentals specifically, as well as long-term rentals. And so we will talk more in detail on those here in the next coming videos. In general, this is what we're looking at and how we take those deductions against your ordinary and active income. So stay tuned. Next, we're going to jump into what it looks like from taking losses from your properties and why you can actually take a tax loss and how you can actually take a tax loss while still getting a monthly cash flow from your real estate properties. Stay tuned, guys. Thanks.